penny wise and pound foolish, why smart investors are getting ready to pay taxes on their cryptocurrency assets. Whether it's clipping coupons or scouring the internet for the cheapest tickets, we all like to save a buck. However, sometimes the efforts we make to avoid financial liability cost us even more down the road. As the Internal Revenue Service bears down on cryptocurrency assets, more and more Bitcoin holders are getting worried about tax liability. A few are tempted to try and evade tax liability by moving or hiding their crypto assets. However, this is a very dangerous game. While it may seem like a good idea at the time, avoiding tax liability by pretending your wallet was lost, stolen, or hacked can expose you to legal and financial liability in the future. The IRS has never been shy about flexing its enforcement muscle, and you never want to find yourself on the wrong end of a federal suit. Tax evasion is never okay, but smart tax planning is a good way to avoid excessive payments to the IRS. The skilled cryptocurrency accountants at Happy Tax can get you the tax advice and planning you need to minimize tax exposure on your virtual currency assets. Bitcoin theft or fraud impacts your tax liability. People who got in early on Bitcoin, Bitcoin Cash, Ethereum, and the thousands of other cryptocurrencies launched in the past few years have seen significant returns. However, the huge profits cryptocurrency investors have enjoyed has also made them targets for internet crimes. Like pretty much everything else that runs on your computer, virtual currencies are made up of complex software coding. We can try and protect our Bitcoin and other cryptocurrency assets by using specialized encryption or authentication methods. However, talented computer hackers can gain access to cryptocurrency wallets and withdraw all of your funds if you aren't careful. Even investors who keep their virtual currency wallets totally secure can still succumb to fraudulent initial coin offerings, ICO, or complex crypto Ponzi schemes. Thinking about evading taxes on crypto assets? Think again. Because the IRS treats cryptocurrency as an asset, it allows investors to write off virtual currency losses or thefts. In some cases, the deductions allowed by these losses can greatly reduce tax liability. This rule provides some peace of mind for the thousands of people impacted by internet fraud, but it also creates the temptation to try and game the system. Some investors may think it's a good idea to pretend that their cryptocurrency was lost or stolen in order to try to hide them from the government and take advantage of related tax deductions. Aside from the ethical issues of such a strategy, lying to the IRS can land you in serious trouble. Depending on the circumstances, you can be hit with staggering fines and penalties or even jail time for intentional misrepresentation to the IRS. Cryptocurrency accountants help keep you and your assets safe. The risks of tax evasion greatly outweigh the rewards. However, there's nothing wrong with planning your finances in a way that minimizes your tax exposure. Happy Tax is here to make sure you avoid the tax pitfalls that may impact your virtual currency investments. The certified public accountants at Happy Tax can work with you to minimize your tax payments in a safe, legal, and effective way.